Well, good morning, everyone. I'm so glad you could join us today. Shawn and I are extremely excited about the presentation that we've got in store for you. We think you're going to learn a lot. We hopefully will keep you up to date on everything. And so we just thank you for tuning in. Our primary goal is to bring some fresh perspective to the real impacts of the 2024 election now that we know who our elected leaders are. Just a note, we are only going to discuss topics that could impact your tax, financial, and estate planning strategies. We're going to do our best to remain as apolitical as possible. This election season seemed to be even more tumultuous than ever before. It brought emotions to an incredibly high level. With that, our second and third goal for today are to help us all get a little more comfortable with the current leadership so that we leave with a better sense of confidence that everything will be better. We'll have a sense that we can leave with an understanding to prepare for some of the upcoming policy changes that may be heading our way. For those of you who don't know me, there are a few that are on the call that are brand new. Welcome, of course. I'm Marshall Gunn. I'm the primary shareholder of Gunn of Gunn Company CPAs and have been involved in the financial planning world for about getting close to 5 decades. So been through a lot of elections, a lot of financial planning with respect to elections, and just love what I do and am thrilled to be able to present this to you today. We have clients from literally all over the world. A number of clients are on from Europe, from the Caribbean, all over the United States, and it's just our pleasure to bring this to you today. I keep saying our because joining me today is Shawn McCabe. In case you missed it last quarter, Shawn is the newest member of our firm. We're thrilled to have him. You're going to learn a lot from him today, I can promise you that. For the last few years, Shawn was the director of CPA Alliance and a partner with CPS Investment Advisors. In that capacity, we were his client. During that time, we were able to experience firsthand his commitment to client service. So Shawn has joined us as a CPA financial advisor, working with small businesses and individuals, and we look forward to you having the opportunity to meet with him in person. We'll hear from Shawn throughout the presentation today, as I will be tagging back and forth, trying to make sure we cover all those topics that are important to you and answer your questions as well. So, politics are on break. So who is where? Well, here's how the election went. Basically, there were 7 ways that people were able to vote. You had people who their voting was, I like Harris. There were people who were, I like the Democratic platform. There were people, I can't vote for Trump. There were people, I like Trump. There were people, I like the Republican platform. And there were people, I can't vote for Harris. And then there were those who were, I refuse to vote. So you had really 7 choices to decide how you were going to vote. And the exit polls show us that all 6 of those, because you wouldn't be in an exit poll if you didn't vote, all of those top 6 just permeated the thought processes of the electorate through this round. A very interesting situation. So to just about everyone's surprise, the Republicans will have the majority in both houses of Congress and the White House. And generally that means the Republicans have 2 years to pass a legislative agenda. However, currently the Republican Party seems to be split into 2 camps, the pro-Trump camp and the anti-Trump camp. So you might say we have 3 parties in House and 3 parties in the Senate. I don't know where that's going to end up, but it's going to be something to watch. Starting in January, President Trump will be in charge of the world's most powerful military and the world's largest economy. Depending on one's political leanings, the news could bring despair or delight. Of the 538 electoral votes, Harris got 226, Trump 312, giving Trump the Electoral College as well as the popular vote. While much campaign rhetoric dealt with social issues like immigration, abortion, DEI, LGBTQ, when it came time to vote, the issues were immigration, eggs, milk, and bread. The electorate voted their wallet. The American consumer, the voters, once again proved it's the economy, stupid. We learned that back in 1992, I believe it was. In the Senate, got 100 seats. The GOP have 53, Democrats 45, and then we have two unaffiliated, just to make it fun, Angus King from Maine and Bernie Sanders from Vermont, which, as we know, traditionally lean toward the Democratic side. The Republicans have a clear majority of the 53 seats, and as we learned yesterday, the new Senate Majority Leader is John Thune, a Republican from South Dakota. For the record, Thune is not pro-Trump. I wouldn't really call him anti-Trump, but he leans a little more to the anti than the pro. The pro candidate was Rick Scott, who, of course, being in Florida, he is one of our senators, but Rick didn't win. So we'll back John and hope for the best in the Senate. In the House, as of 8:49 last night, the Republicans now control 218 seats and have a majority in the House. When you look at that House map, it actually has a little better coverage than Verizon does. The House is a little closer with the Republicans barely in control with the 218 seats. So far, keep in mind, there's a couple of elections or a couple of districts that are still being decided. But it would appear that after the bitter infighting that resulted in the election of Mike Johnson earlier this year, I guess it was, he will remain Speaker of the House. So we have the leadership in the House, in the Senate, and the White House for next year. That's in place. Well, there's another segment of our balance of power, and that's the Supreme Court. The Supreme Court is graying. Clarence Thomas is 76, Samuel Alito Jr. 74, Sonia Sotomayor is 70, and Chief Justice John Roberts Jr. 69. All but Sotomayor were nominated by Presidents Bush, presidents plural, catch that, and are considered conservative. Sotomayor was appointed by Barack Obama in 2010, so don't be surprised if Thomas, Alito, and Roberts retire during the next 2 years. Any Trump nominee would be a virtual shoo-in. So a lot on the plate. Shawn, help us out a little bit here.
All right. Thanks, Marshall. Good morning, everybody. Thanks again for tuning in. Thanks for having me. Some of you may be wondering why the election results are what they are, right? Which we believe is important to understand as we try and parse out the impacts of the election on our financial planning and our financial lives. So according to exit polls, which is what we have to go on right now, everything's still new, still early, a lot of things still reporting in, a lot of interpretation of what happened. The top three factors that persuaded voters at the polls were the state of democracy, was 34% of voters, the economy itself, 32% of voters, abortion was 14% of voters. And I'd like just to note here that you're looking at 66% of voters voted based on the economy and the state of democracy. The state of democracy arguably is a very subjective thing, whereas the economy is a very measurable and easily articulable thing. So with that being said, while the state of democracy and abortion are important topics that impact our way of life and how the election went, we're really not going to touch that. We're going to keep our attention focused on the economic side of things. As Marshall said, we're going to keep politics out of this. So let's get back to what Marshall said. It looks like the electorate voted with their wallets. And if you were looking at inflation over the last 4 years, it's really easy to see why. I showed this chart a few weeks ago during our quarterly economic update. There are two main things I want to point out. Number one, inflation is usually measured by change year over year, which diminishes, in my opinion, the visual effects of compounding. And two, the mix of said inflation changes. My point here is, while inflation is a lot lower than it was 2 years ago, the effects of higher inflation, especially in the categories highlighted on this chart, still have consumers feeling it in their wallets, and they will for some time. And I really think this is what led voters to vote the way they did in a lot of ways. So digging in for a little bit here, over the last couple of years, some of the biggest contributors to inflation have been energy, which is measured by the green bar. I know this is hard to see, so I'm just going to call them out for you. The food, the last couple of years is measured by the purple bar. Housing is dark blue, and core goods is orange. Whereas over the last 12 to 18 months, only energy and core goods have provided some relief. What I mean by that is costs were actually lower. You paid less for it. Whereas housing, again in dark blue, insurance in red, and dining out, light blue again, have continued to cost more. Even though the rate at which they cost more has slowed, which was what everyone's focusing on, hey, inflation's down, it doesn't matter. Consumers are still paying substantially more than they did 5 years ago, and they blame the current administration for it. Getting into the economic cycle of things, let's bring it out a bit. And let's remember, the business cycle is way more powerful than elections. And my point here is it doesn't matter who's in office. From all the research we've done, many sources say the US is towards the end of the mid-stage economic cycle, or maybe in the early, late stage of the economic cycle. All this means is we've had a good economic run. It could continue to last for several more years, but it won't last forever. And I always like to say my crystal ball says we're heading to a recession, but every time I ask it when, it doesn't give me an answer. So as we move into there's always a reason not to invest. And we cover this slide just about every presentation we do for a reason. We occasionally hear it's different this time, or it's Biden's fault, or back in the day it's Bush's fault, or it's Obama's fault. The reality is it is not different this time. It never is. And who knows what the reason will be for 2024. Maybe we'll upgrade Pluto back to a planet. I'm joking about 2006 like I always do. But there's a lot of things we can blame this year on, why not to invest. This has been a good year so far. It's not over yet. What we do know is on Wednesday, November 6th, the day after the election, the market spoke loud and clear about the U.S. political situation. How much of that rally was due to the uncertainty of the outcome, or how much of it was due to the actual outcome, really is anyone's guess. But the reality is the results were unquestionable. This chart I wanted to show you, again, we kind of covered this in our economic updates the last couple of quarters, just to give everyone some important perspective. This chart would argue that the November 6th market rally was more about certainty than anything else. Meaning, it doesn't matter who's in office. We know it's settled. We know it's done. Let's plan. Let's get on with it. Let's move forward. And the S&P grew, looking at this chart here, the S&P grew no matter which presidential party was in the White House, all the way back to President Herbert Hoover, which I kind of feel bad for him. But hey, I wasn't alive then, didn't know the details of what was going on. But his presidency was dominated by the stock market crash of 29 and the beginning of the Great Recession. He only lasted one term for that one. The only thing that changes in the market when a new president takes office is who takes credit for the momentum. I'm going to say that again. The only thing that changes in the market when a new president takes office who takes credit for the momentum. Kind of looking at it from a different perspective here. GDP. How is GDP impacted by a new presidency? Gross domestic product, with a measure of goods and services provided by the U.S. It doesn't matter. As you can see from this chart as well, GDP growth, no matter which presidential party is in the White House, once more, back to Herbert Hoover, we're going to pause there. The only thing that has changed economically when a new president takes office, again, is who takes credit for that momentum. One more slide here to make that point completely clear and hopefully get everybody a little more comfortable, whether you're pro-Trump, anti-Trump. In terms of best performance of the S&P over the last 73 years, it's often better for the market when Congress is divided. And no matter which party controls the White House, but even when one party has control of both houses and the White House, the market still performs. And I kind of like what Marshall said a few slides back. Even though the House, both houses are red or Republican, there's a huge divide in the the Republicans in the House and the Senate. Like you have your pro-Trumpers and your anti-Trumpers. So I expect, throwing some opinion in here, that it's going to feel like a divided Congress as we move forward. And I think the reasons for this is twofold. Number one, politics doesn't matter, policy does, which I'll dive a little deeper into a few slides. I got some points I want to make there. And two, like I mentioned during the economic update last quarter, the resilience, ingenuity, and drive of the American entrepreneur and corporate America to make a profit will overcome uncertainty and the market fluctuations that come along with it. It has for the last 100 years. So, Marshall, speaking of uncertainty, why don't you give us some thoughts on it?
Well, investing in uncertain times. I love this slide. We use it for every presentation because I'm always hopeful there will be certain times one day. So here we go.
Yeah, right.
What happens if your candidate or the other candidate won? The danger is twofold. If someone is convinced that the economy's future is bleak, they may be tempted to sell off assets or make overly risk-averse choices. On the other hand, if a client is thrilled that Trump won, they may have unrealistically high hopes and become too risk on. So there has to be balance. Think further into the future than 4 or 8 years. With stocks in particular, the economic mismanagement of one president may bring a temporary downturn. But over the long run, the overall direction is and has been up. Overall, you're betting on the market and that discipline wins over time rather than who is occupying the Oval Office. Regardless of whether you're experiencing exuberance or disappointment, the market has shown time and time again it's more resilient than any president residing in Pennsylvania Avenue. You think Shawn and I are trying to drive that point home. We are. So clients keep asking, Marshall, when's the next correction? You know, the market's been so great for 2024. I made a lot of money, but gosh, should I be taking money off the table because I'm afraid there's going to be a recession? Guess what? There's going to be a recession. I'll give you another one. It's going to rain. I mean, those are just the normal courses of things. So the answer statistically is yes. I want to share this chart to reflect how frequently the market takes a breather and the depth of those breathers. Don't be surprised if it takes a breather. This is perfectly normal. A dip. Let's go to the bottom of the chart. We'll work our way up. A dip is a 3% decline in the market. That happens about 7.2 times a year. That's normal. A pullback, 5%, 3 times a year. A correction greater than 10%, once a year. A severe correction greater than 20%, about every 2 years. And then a bear market greater than 20%, of course, that's about every 4 years. So those things happen. This is the normal course of things. Don't be surprised if you see some adjustments in the marketplace. Keep in mind, capital doesn't get destroyed. It simply moves around. I mean, the money doesn't evaporate. If somebody's selling a share of XYZ company because they want to put it in something else, the money's still there. It's just moved around. So my advice is to control the things you can, diversify your exposure to those things that you can't. We use this slide all the time. What does it mean for investors? Investors often feel more bullish when their preferred party is in power. That's a given. And they're more bearish when the opposite party is in power. They like that feeling of control, that it's my person in control. I'd rather be themselves in control, of course, but we can't all be in control. While policies do matter, as Shawn presented, markets are nonpartisan and have historically risen under nearly every partisan combination. Although it can be tempting to let initial feelings of optimism or pessimism drive one's investment strategy, a sounder course of action is to make that long-term plan that meets your needs and goals and stick with it. Focus on the things you can control, like strengthening relationships with family and friends, not deleting them from Facebook because they supported the other candidate or they supported the candidate you didn't like, taking care of yourself physically, and so on. Always, as we say, turn off the news. And if you ever need support on your financial journey, of course, we're here to help. A frequent question has been, which sectors should benefit from a Trump presidency? Well, the nice side is this is version 2.0. So we can look back to the first Trump presidency with some confidence. Of course, that presidency was wild and crazy because of COVID, but there were some things, and what I'll call the Trump agenda leans in a number of areas. So from a sector standpoint, financial institutions should see fewer regulation. Energy, we're already committed to sell natural gas to the Eurozone. Oil and energy field services, the drill, baby, drill concept is already on the tables. There are favorable policies for American oil companies. Hospitality side, especially cruise operators. Think about it for a minute. What's one of the biggest costs for cruise operators? The lower cost of fuel will help cruise operators, plain and simple. It will help airlines. It will help trucking and rail. That anticipated lower fuel cost is fueling, if you will, some activity in those sectors. Defense, global unrest, and the Trump policy push for other countries to defend yourself. You need to be investing in your own weaponry. Well, where are they going to go for that weaponry? They're going to come to the U.S. So defense should be favorable during a Trump administration. And of course, technology. I'm sure you've heard the involvement from Elon Musk and others that are in the technological world, and we expect that there will be a continued favorable policy on stock buybacks, tariff protectionism, and more lenient on mergers and acquisitions. Of course, we'll wait and see as all that evolves in the coming months, but that's the short answer, I guess, to that frequent question of who should be winners. So, what do we really expect to happen? The first thing, of course, is going to be executive orders. If recent elections are any indicator, there'll be volumes of executive orders signed as soon as the president is sworn in and can get back to the Oval Office. It seems each new president tries to outdo the prior with immediate executive orders. Areas most likely affected are expected to be more social than economic. Shawn, you want to cover a few of these things?
I do, Marshall, and you're right. There's a lot to unpack here. So as we all know, campaign promises usually differ widely from what reality is. And so I want to spend a few minutes and talk about that point and kind of maybe explain to some that may not be plugged into politics, as I wasn't before. There's circuit breakers in place to help protect it going hard right or hard left or just going completely off the rails. Thanks to our forefathers for putting this in place. So before we dive into the potential policy changes that we're going to walk through with you guys over the next couple of years, because of the new administration, I want us all to understand how Congress and the tax law process will play out. And just as we consider the historical budget reconciliation bills used by both Republicans and Democrats over the past 20 years or so. And there's a really obscure, maybe not so obscure aspect of that procedure called the Byrd Rule. And while some campaign promises sounded good, and for a lot of people on Social Security sounds great. No tax on Social Security, no tax on tips, changes to the state and local tax deduction, enhancements to the R&D tax credits, increases to the child tax credits. Rest assured, there are limiting measures in place, again, like the Byrd Rule, to help prevent unilateral changes like this. Outside, though, of the budget reconciliation bills, and again, the reason the budget reconciliation bills are important is because it only requires simple majority, hence those limiting measures, right, to prevent runaway legislation unchecked. But if something's trying to pass outside of those budget reconciliation bills, then that's when those concepts would need the Senate's 60-vote filibuster threshold to be put on the president's desk. And again, to kind of dive a little bit into what that Byrd Rule is, it forbids the Senate from using the reconciliation process for any bills that raise the deficit beyond 10 years and makes changes to the Social Security, to name two. The latter, where we get the fairly obscure aspect of the Byrd Rule, aka no changes to Social Security, likely rules out any provisions exempting Social Security benefits from income tax. So you may have heard it already in the news outlets that this concept, amongst others, that no tax on Social Security, are non-starters in Congress. Well, that's why they're able to say that with confidence. The Byrd Rule limits that. Similarly, that's why the Tax Cuts and Jobs Act of 2017 expired in 2025. The duration of that bill was limited because of that Byrd Rule. So things that are not budget related are not to be included in the budget reconciliation bill process. Hence, the big debates about whether something is really incidental to the budget or not. But we have seen proposals regarding, even if it's incidental to the budget or not, we still see the Senate try it, right? We've seen proposals regarding abortion, proposals regarding minimum wage, proposals regarding immigration reform, all put forth in the budget reconciliation bills, but are quickly, wiped out because they're limited by the Byrd Rule. They don't belong there. They keep trying. Well, so I'm saying all that to say this. even with the Trump victory, in a majority in the House, in the Senate, Republicans, there's still going to be a very conscious, the Republicans that are, the administration is going to be very conscious of adding to the debt. That's something that they didn't really talk about in the campaign this year. A Republican-led White House, Republican-led Congress will need to consider how to address those things, like the research and development tax credit deductions, state and local tax duties, and the child tax credit, amongst many other provisions set to expire. The fact that the government's debt has risen so sharply since 2017 means that a full-on extension of the Tax Cuts and Jobs Act is going to be highly challenged. I know that was a lot, but keep in mind the main point of that previous slide was just to say, hey, there are measures in place to prevent things from going crazy. And like Marshall said earlier, we're kind of looking at, even though it's Republican House and Senate, they're still divided, and we're kind of looking at it as a divided Congress. So now, hopefully, you see why when we say potential here, and why we say it's about policy, not politics. You can understand it. It takes a lot to get new policy through. So please, please, please keep that in mind. The next section is still very much speculative, but as we continue from election to inauguration to the first session, we'll continue to dial in the focus and begin to help you take action in your tax, financial, and estate plans. So Marshall and I will both tell you, unilaterally, to do not take any unusual actions now. Just know that we're keeping up with it. We know your individual situation better than anyone, except for you, of course. And we'll be the first to advise you on how to proceed if and when the time comes and some of these legislative changes get pushed through. So Marshall, why don't you kick us off with the potential individual tax proposals from the upcoming Trump administration?
Here's our best guess. Here are the proposals made during the Trump campaign as compared to current law to give us all an idea of where we could be heading. Current law, tip income. Hey, it's taxable. Income, it's just another source of taxable income. Well, the Trump advance proposal proposes eliminating taxing tip income. We'll see. Current federal law on Social Security, it's subject to lower tax rates a little bit because the maximum is only 85% taxable. And total income takes into account all types of income, including Social Security benefits. Trump advance proposal, eliminating taxation on Social Security. And go on the hook. As Shawn just alluded to, probably not going to happen. Current federal law, overtime income is subject. So in addition to not taxing income from tip, Social Security, and overtime, Trump has made some proposal to eliminate income for firefighters, police officers, and members of the military. The one that I'm most drawn to is elimination of overtime. Shawn, think about that. That could be a sweet deal when it comes to all those hours we work during tax season. Probably not going to happen. Shawn, I'm going to step out on a limb and make a personal projection here. The current law has the 7 brackets. We've got 2026. Everything reverts to the Tax Cuts and Jobs Act. Trump and Vance want to make that permanent. Well, Marshall's going out on the hook. It will not be made permanent, but will be extended into 2029. Why 2029? Well, that's when the Democrats and the anti-Trump camp can rest assured he will not be in office. This was the same thing they did back in 2017. As Shawn told us, there's a 10-year window. They compromised on an 8-year window to make all of the Tax Cuts and Jobs Act goodies, if you will, that were in that bill expire in 2025. Well, they knew that Trump would not be in office. They would have a new administration in office. And so that was the methodology that went into the legislation that came out then. The compromise that if he had been elected for a second term in 2020, he wouldn't have been there by the end of 2025. So in typical Congress fashion, just keep kicking the can down the road. Okay, Shawn, I stuck my neck out here. Bail me out.
I don't know that I'm going to need to bail you out. I think you're right on the money with that one, Marshall. Gotta love it. So what I'm going to do, though, is stick my neck a little bit out on the individual deductions and credit proposals, similar to what you said. Probably gets kicked down the road a little bit. But so let's just say that Trump has called for eliminating the Tax Cuts and Jobs Act 10,000 limit on state and local tax deductions, also known as SALT. You maybe heard that kicked around for individuals or raising it. Trump has also called for doubling the standard deduction. That could cause even fewer people to itemize their deductions. There's a good amount of people who don't itemize because the SALT cap is limited to 10,000. You can't take more, doesn't push them over the threshold. And then if you don't have large home mortgage interests or itemized deduction, you're not going to get over that standard deduction threshold as it currently stands. If you double this deduction, there will be less and less itemizers. And those types of deductions don't become as valuable. That may prompt donors to reduce their charitable contributions if they can't itemize those deductions. So there would also be fewer returns to audit, thus reduce the number of IRS employees. It's a waterfall. Speaking of which, the Internal Revenue Service may be facing steep cuts in its budget. We started to see this happen already as funding for the IRS has become a political issue. Now with Republicans successfully pushing to cut the extra $80 billion funding from the Inflation Reduction Act of 22, already during battles over the debt limit. So far, Republicans have mainly called for cuts in the IRS's enforcement budget. The increase in the enforcement is supposed to be used to pay for the cost of the IRS. But the funding increase is also supposed to be used for taxpayer service and technology improvements. I don't know, Marshall, when you call the IRS line, have you noticed any enhancements there yet? I sure haven't.
Actually, my call gets continuously dropped. So yeah, no enhancements.
Yeah. The question on funding is, will any portion of the funding remain available for taxpayer service related improvements at the IRS? Who knows? Moving on a little bit, though, the qualified business income deduction under the TCJA will also be closely watched. People would be looking for that to either get extended or made permanent. QBI deduction is 20%, is a 20% deduction on certain flow-through income, which has been very beneficial to people who it applies to, small business owners. Unfortunately, it does not apply for the most part to accountants and other professional service organizations. There we go again, Marshall. They keep putting it to us.
Yep.
Trump has also called for other tax breaks, such as tax credits for family caregivers, taking care of parents with loved ones, and allowing those who buy an automobile made in the U.S. to write off the interest on their car loans. That'd be cool. Trump's tax policy will also depend on Congress, on what Congress does and how much control Republicans will be able to exercise, especially in that House. Got to reach that filibuster. So let's talk about the current child tax credit. Current law, which is set to expire in 25, it's $2,000 per qualifying child. It does phase out at adjusted gross income levels. Starting in 26, that gets cut in half back to $1,000. Supporters, Trump and Vance do support permanently extending that. It would lock in the current credit amount, and they would adjust for inflation, and then higher those phase-out limits. And one point I want to make on kind of talking about how is all these tax cuts going to get paid for. Trump promised to implement high tariffs on goods entering the U.S. That from the campaign promises, that's what we could put together. But economists and others question whether the tariff rates he was generally suggesting would even cover that cost. So, like we mentioned above, a lot of this will take time to be sifted through and decided on. To that point, Marshall will talk a little bit more about the potential tariff impacts in a few slides. For now, though, Marshall, there's been a lot of talk surrounding the expiring estate tax provisions of the Tax Cuts and Jobs Act. Would you mind sharing your thoughts on that?
Absolutely. The extension of the Tax Cuts and Jobs Act of 2017 will continue the current 13.61 million or 27.22 million for married couples federal estate gift and generation skipping transfer tax exemption to transfer wealth and mitigate some of the estate or gift tax burdens. And let me tell you what that means. That means that as long as your estate, if you're a married couple, is less than $27.22 million, you don't pay any estate tax. We all hope this is a real problem for our heirs, that I can leave them more than that. And the number goes up in 2025 to 13.99 million or 27.98 million if you're married. So those wishing to transfer wealth to loved ones have a lot of space, obviously, to transfer wealth. In addition, there's the annual gift tax exclusion, which is $18,000 per individual or $36,000 per couple in 2024, and that increases to $19,000 in 2025. So I'll make the call. I think that we'll see this to continue. The threat of getting it back, and you heard some campaign rhetoric, get it back to $1 million a person, $3 million a person. I just don't see that happening. If it stays at this level, that would be really nice, but I think there may be some trimming here, but not dramatic as was touted in the campaign. Let's look at some business tax proposals. Well, of course, during the first Trump administration, corporate tax rate got reduced to 21%. Trump advance proposal has been, first of all, to take it down to 20, and then it came out to support a 6% decline down to 15%. Well, going from 21 to 20 may be much easier to sell than layering on something that would get the corporate rate down to 15. Remember, we have a huge debt and deficit. In other words, that's a polite way of saying we're broke and the credit cards are maxed out. So I don't see the 15 being a reality. The budget just can't handle that. Now, Trump has also called for bringing back the 100% bonus depreciation. Right now, that rate is 40%, scheduled to go down to 20 next year. You can see the phase out. There's been a push to get that back to 100% to promote small business and to move that backbone, bread and butter businesses of America to assist them. The treatment of R&D expenses, research and development that is, involves another provision of the Tax Credit and Jobs Act that could be eliminated. The last couple of years, taxpayers have had to capitalize research and development costs and then amortize them. That's a significant impact on compliance and the bottom line of taxable income. Trump has said he'd like to go to expenses currently deductible again to stimulate expense in research and development, especially in the technology area, which is what I alluded to on a prior slide. A side note, some of these business tax changes were passed by the House earlier this year as part of the Wyden-Smith Tax Relief for American Workers and Families Act of 2024. But that never got through the Senate because of disagreement over other provisions, such as the expansion of the child tax credit. Don't be surprised if much that was in that particular act rears its head again and becomes part of the upcoming proposals. Trump has also called for eliminating stock buyback excise taxes on public companies that buy back their own shares of over $1 million in a taxable year. This is why I mentioned that earlier, that technology has been one of the areas where we've seen a lot of stock buybacks happening. We expect that could be a very strong item to come in next year. Right now, there's that 1% tax, and the Biden administration had proposed increasing it to 4%. Trump's is in favor of eliminating the tax. My guess is it may or may not get eliminated, but I definitely don't see it being increased. Tariffs, tariffs, tariffs. Oh my gosh, we've heard a lot about tariffs during the campaign. While President-elect Trump needs Congress to legislate tax policy changes, he can use executive order to push other key priorities. We saw this, 8 years ago, maybe 7 now. Trump imposed certain targeted tariffs during his first administration, many of which were the subject of much ridicule and debate. However, the surprising thing is when the Biden administration was elected, most of those were kept in place. And not only kept in place, but expanded upon by the Biden administration. During the 2024 campaign, Trump proposed more sweeping levies up to 60% on imports from China and 10% on all foreign goods. Stay tuned on this one. This is going to get a lot of airplay in the coming months. U.S. debt. Okay, I just said we were broke and the credit cards are maxed out. So keep in mind, tax negotiations will take place under the shadow of that debt and the record federal deficit I just mentioned a minute ago. The current suspension of the U.S. debt limit, what most people refer to as the debt ceiling, or that max limit that they put on your credit card, that ends January 1 of 25, at which point then Treasury Secretary Yellen may need to invoke so-called extraordinary measures so that the federal government can continue to meet its obligations, potentially delaying debt ceiling talks until the summer. In other words, again, kick the can down the road. Now, we're going to hear right around Christmas to New Year's that if certain things aren't done, the government's going to shut down and our credit rating is going to be reduced. And this will have some impact on the volatility of the market. Keep in mind, when you look in the rearview mirror, it's what's happened always before. It's just noise. The reality is they're not going to shut the government down. We can pretty much bet on that. They're going to try to save face, pass some legislation, and get that one done. The higher level of interest rates might bring new sense of urgency to this issue in 2025. As we've seen, the 10-year Treasury has ticked up a little bit so that the money that the U.S. is paying in interest payments has bumped up. The 2025 interest payments as a percentage of GDP will reach its highest point on record since the government began collecting this data in 1940. U.S. government debt relative to GDP has tripled in the past 2 decades, but it hasn't been a significant issue for the financial markets because interest rates were low and the debt service was manageable. If interest rates stay around where they are today, the 2025 fiscal debate will take place in a different context, and that has the potential to create interest rate and market volatility. Stay tuned. Shawn, help us out with the global perspective.
And Marshall, just a touch point on the national debt was one thing that wasn't discussed that heavily, in my perspective during the election. I think that was a hot potato that neither candidate wanted to get into. And it is going to impact the global arena. So good segue here. And there's undoubtedly a lot to unpack globally with the second Trump administration. I think you're hearing the outlets call it Trump 2.0. For now, we'll keep our global assessment at a really high level. We could probably spend 3 or 4 hours going through it. So in the global arena, the first thing that I think of is the U.S. dollar strength. We've seen a lot that in the strengthening of the dollar over the last year against the bigger currencies. So we'll need to keep our eye on that. It's continued to strengthen amongst other dominant world currencies. The Trump election has added to the dollar strength even more. This is good and bad news, right? A stronger dollar makes products made overseas cheaper, but at the same time may hinder U.S. companies that export products globally. It's great for Americans traveling abroad, but much more expensive for foreign travelers traveling to the U.S. And as Marshall was talking about the tariffs, it's a board of widgets that are all interconnected. When you turn one, they all turn. So it's kind of hard to assess at this point, where the dollar is going to go. But for now, the world's looking at the reserve currency as stronger than ever. We'll also need to pay attention to President-elect Trump's actions with tariffs. Like we said, Marshall covered this already. He's potentially talking about a 60% tariff on China, and 10 to 20% tariff on imports from all other countries. And the question is really, is he using this as negotiation tactics or campaign rhetoric, if you will, or as a tool to pay for tax reductions in the national debt? Don't know. Hopefully we'll get that figured out here shortly too. We'll probably learn a lot as we get through that first session early next year. And there are good arguments for and against tariffs, but the reality is what was campaigned on may not be what is enacted. And the potential impacts of tariffs are too far reaching at this point to make any sense of it during this presentation. Again, we'll have to wait and see. As President-elect Trump continues to build out his cabinet, we'll begin to get a better idea as to how his administration will run and how they'll approach global issues. For now, though, we know he has picked Marco Rubio. I think that was a recent pick, a Republican from Florida, for Secretary of State. And Marco Rubio has publicly declared a hardline stance against Hamas, which I would expect would trickle down to a stronger support of Israel and hopefully a faster end of the conflict in that region. And, very important point to note is, when we're looking at our investments of the world, our financial planning, the markets do not like uncertainty. So from an international perspective, there's still a lot of uncertainty out there, particularly speaking in the Middle East and also up with Russia and Ukraine. So hopefully we see some resolution there. Another interesting cabinet position, I almost thought they were joking, was Department of Government Efficiency, which will be jointly filled by Elon Musk and Vivek Ramaswamy. You may remember him. He was an early contender on the Republican side for the White House. But they're going to focus on regulating government spending. Now, again, the reality here is Trump will need congressional support if this new department, I'm air quoting, you can't see me, will become an actual government agency. There's a lot of hair on this for sure, but nonetheless, interesting to see how Trump will unconventionally continue to build his cabinet, his team. Marshall, before I move on, do you have anything to add to the global arena?
No, I think it's interesting. We have so many people as I look at the list of attendees from Europe, and
Yeah.
it'll just be interesting to see how all this comes to bear. The relationships with Putin will be very
Yep.
interesting, and I encourage that support for Israel.
Indeed. Good. Thank you for that. So the question really is, what should you be doing now? So then, Marshall, how about I turn it over to you to help answer the most important question of the day? What should we be
All
doing now?
right, tax planning. Get Uncle Sam out of my wallet. With the election over and the end of the year fast approaching, we wanted to do a little year-end housekeeping that could help lower your taxable income, maximize your charitable deductions, and reduce exposure to future taxes. The outcome of the election will most likely mean no significant changes in tax brackets for 24 versus 25 and most likely beyond. So the traditional tax planning remains. Shawn, kick it off for us.
I'd love to. So let's talk about lowering your taxable income at the end of the year. So Marshall, this is where you and I get to nerd out a little bit for our friends on the call. The end of the year is a great time, as Marshall said, to take stock of what opportunities are available to all of us and how we can use them to our advantage. Here are some ways I like to cut down to the chase here that, maybe hanging out there for you to take advantage of. First thing is tax loss harvesting. Here, it's where investment losses can be used to offset any gains you realized in 24. We know the market's been up, but it all depends on your situation. You can offset, obviously, your other passive income or up to $3,000 of earned income from, harvesting tax losses there. And we would suggest consider selling depreciated securities that long will fit your strategy or have poor prospects of doing well in the future. Or you may be able to replace them with similar investments that play a similar role in your portfolio. And there's also some strategies there. If you do want to hold something long term, you could sell it, buy it back at a later time, take advantage of that tax loss to offset some gains somewhere else. But I would caution you there, if you do that, to be mindful of the wash sale rule and really just call us. We'll help you walk through that. The second thing up here for lowering taxable income for the year is contributing to tax advantage accounts. Kind of a no-brainer. But a lot of people often overlook this and forget about it until April because they confuse the IRA contribution deadline with their 401k contribution deadline, which has to be done by 12/31. So contributions to your 401k, 403b, and my absolute favorite strategy in the world, the HSA, could potentially lower your taxable income for the year, increase the assets you have available for future retirement, and potentially use for the HSA used to pay some medical expenses. Get it all deductible, all tax-free, even if you're under that 7.5% limitation there. So it's good practice to review your contributions before year end to ensure you're taking full advantage of this. If you're unsure, again, reach out to us, give us a call. We'll point in the right direction. Last thing before I step into the next section is for my Schedule C filers, my small business owners. I'll preface this by saying, please, please, please don't let the tax tail wag the dog. Don't go out and run and buy a truck. Shawn said it's going to save you on taxes. But if there is an opportunity for you to make some purchases for your business to be used in the business before 12/31 instead of in January, it may make sense to do so. I said this on every bullet so far, but check with us if you have concerns or questions about this. There are opportunities we can shift around some of your expenses and even in your income in certain situations to better benefit you in the tax for this year. The next thing is maximizing your charitable deductions. So if you're like me, your mailbox is probably starting to fill up with letters from the charities you supported last year asking for additional end of year contributions. It's a great time to give, but our job is to help you, give smartly. And it's inherently rewarding. We know that. We love giving to our charities. But here's a couple strategies for you. One is if you haven't thought about it, cash flow permitting, of course, is to bunch charitable contributions. If you had a great year, like a lot of people I've talked to have this year, it may be wise to go ahead and make 2 or 3 years worth of charitable contributions this year, so you can get over that itemization threshold and take that versus splitting them over multiple years and taking the standard deduction each year. A little bit of a tax play there. You got to do your calcs, see if it makes sense. Donating appreciating assets. It's a great opportunity for you. If you are an itemized deductor, you can donate an asset held for longer than 1 year to a qualified public charity. You may be able to deduct the fair market value of the asset without paying capital gains on the sale. And that contribution, while subject to the 30% adjusted gross income deduction, is deductible. Cash contributions, of course, are always good to go. If you're itemizing deductions, remember that up to 60% of your AGI can be deducted for cash contributions made to qualified charities. Last but not least is, and Marshall, I stole this one from you. I apologize, but I really like this strategy. I feel like it falls under this section and not the next one. But if I miss something, fill me in. Qualified charitable deductions. If you are age 70 and a half or older and have an IRA, you may want to consider making a direct transfer of up to $105,000 single, $210 married from your IRA to an eligible charity. This could potentially reduce the amount of current or future required minimum distributions. Additionally, a direct transfer does not increase your AGI. That's the cool part there. And it satisfies your RMD. And it will not adversely affect your itemized deductions, Medicare premiums, or your Social Security benefits. So really cool strategy there. I will caution you, though, on the QCDs. We're getting close to the timeline where some of the broker dealers set to ensure they can guarantee that they get those out timely enough to make it occur for this year. So if that's something you're interested in doing, jump on the horn with us pretty quick to make sure that happens. So Marshall, I apologize. I stole that one from you. I like it. But how about I choose to shoot it over to you for the next year-end strategies?
No problem. Feel free to steal. Year-end strategy isn't just about the here and now. There are several things you can do before the end of the year that can help reduce the impact of future taxes and provide added benefit to your beneficiaries or your favorable causes. As I mentioned earlier, the lifetime estate and tax exemption increased $690,000 just in 2024. So if you've maxed out the exemption, I know we have a couple of people on the call who have maxed out their exemption from gifting prior to 24, here's an opportunity to do some gifting to your family members during 2024 and or even more in 2025. So some good options there if you're trying to give away your estate, so to speak, to avoid any estate taxes. The annual exclusion gifts we talked about. If you're looking for someone to give that $18,000 to this year, that's the time to do it. Keep in mind that can also go to the dollars directly to an educational institution or dollars directly to a medical care provider don't count in the 18,000. So if you're thinking of paying for the grandchild's orthodontics or something, you can do that, and that's not considered gifting. 401k and IRA distributions, even if you're not required to take one, you might want to consider that. Just if you're still in a very low tax bracket, it's just one of those things that when you have your year-end planning with your advisor that you look at. You might take a few $1,000s off the table, but still stay in those low tax brackets. Depends on your individual situation. Roth conversions, if they don't extend the 2017 Tax Cuts and Jobs Act, that those tax rates revert back to the 2017 levels. So we've got some issues there where you might want to consider a Roth IRA conversion because, of course, Roth IRAs build tax-free forever. and don't have required minimum distributions on them. So it's just one more arrow in the quiver that when you're meeting to do the year-end tax planning that you take a look at as, would this make sense for me this year to do a little bit now to save some dollars down the road? The biggest advice I have for you is keep a long-term perspective. We can never predict what the future is going to hold with any certainty. It's never a bad thing to be educated on the possibilities and the different outcomes. But understanding those possibilities, we can build enough flexibility in our plans to ensure that we're able to stay focused on our long-term goals and objectives. So before you determine your next step, consult with your tax advisor and work together to identify the best approach for your specific situation. Now, of course, we are always here to help identify the best approach for your specific situation. Well, Shawn, you and I have gone at this pretty hot and heavy now for a while. I'm going to turn it over, and we got some questions. Of course, we have our expert here to at least make you smile, I hope a little bit. But fortunately, several of you have submitted questions in advance. I'm going to drop those now. So, Shawn, here's your first one. Is Bitcoin or currency stocks really a viable investment play? And a follow-up, do you foresee any black swan events in the next 2 to 4 years?
Marshall, I was ruined once upon a time because you always want to respond when a question's asked like that. Man, that's a great question. And the reality is there ever not a great question? With that, though, this is a great question, and I get it often. And my answer as of right now to answer the first question is no. I believe that cybercurrency is too volatile. It's not a good store of value, in my opinion, and it's a gamble. And to answer the second question, which kind of goes back to answer the first one about a black swan event, it depends on the regulatory environment and generally how people feel about it. Those two combinations are going to really drive what happens in the Bitcoin arena over the next few years. And again, there's no real value other than the blockchain it sits on, which is simply a perfect ledger. That's what the value is. And the fact that it must be converted to a fiat currency to be used. It's speculative. It's a speculative store of value. You could have 100 grand sitting in it today, and all of a sudden the markets think they don't like Bitcoin today, so now it's worth 50 grand. And now your store of value just got cut in half. And for what? People's emotions. With that being said, though, to me, it's still very speculative. It's still speculative play and not worth risking money you have set aside for your financial independence. So hope that answers the question.
I think it does, Shawn. Thank you very much. Hey, we've got one that was sent in through the chat box. Feel free to add to those. I'll take this one. And the question is, how are the high cost of insurance, health, home, and car going to affect the economy and personal savings? Well,
Yes.
boy, we've all felt that pain. Shawn covered on his chart very well, but I'm going to talk about your diversity of the portfolio. So many times I meet with people and they want to be extremely conservative and have their idea of high risk is a 2-year versus a 1-year CD. The reality is inflation, whether it's controlled at 2% or whether it's rampant at 7%, everything we buy seems like it costs more every year. And the game plan is it's going to cost more every year if there's 2% inflation. So you have to stay invested in those assets that will appreciate in times in inflationary periods. And one of those, of course, options is equities, stocks. The second is things like real estate, your personal home, and of course, always a small business. So the impact, to answer the question, is going to be negative. But hopefully the positive is you're invested in the market, your assets are appreciating, even with your higher cost of living expenses, and you're able to weather through the inflationary periods. Shawn, I got another one for you. Should I be adding any oil stocks to my portfolio as a result of Trump winning the election?
Generally speaking, no investment pick should be made solely on the election results. And specifically to oil, though, and Marshall, you covered this real well earlier, actually. Um, there's a lot out there regarding oil we need to keep an eye on. Trump is pro-energy, as we know, which could lead to increased production, more supply, and that could actually drive prices lower. So if you're long oil and your prices are going lower, you're losing. To that point, the administration will need to keep inflation in check, and a good way to do that is to keep energy prices low. So, energy prices low is good for the economy because the cost of goods is lower, and inflation stays lower. So I would say that the downward pressure on oil right now is probably not a good place for anybody to be long oil. So I would say be cautious when looking at oil or any other commodity for long-term investments.
Awesome. Thank you, Shawn.
Of course.
Well, always build your investment portfolio with companies whose profits are not tied to politics, if I can give you the one takeaway. Regardless of who's in the White House, people are going to continue using Charmin, eating, taking their drugs, and using their cell phone. We know that's a case. Wanted to open up one more time. If anybody has anything to add, please, or question, please type it in the chat box. Just to begin our close, if you know someone who would benefit from our webinar, we'll be offering a recording of today's presentation on the Gunn & Company YouTube channel. Once it is posted, we will email a link to all registrants. And as always, feel free to share it with your family and friends. Seeing no final questions from the audience, our next scheduled event will be our annual economic update on Thursday, January 30th, 2025 at 10 a.m. Watch your email for details. I'm sure these next 85 days or so will be very interesting. Thank you so much for joining us. Shawn, thanks for your support and input today. It's great having you on the team. We look forward to meeting with you soon for the year-end tax planning. But again, stay safe, stay diversified, have a wonderful Thanksgiving, Merry Christmas, and Happy New Year. And again, thank you for being with us. Goodbye.